Good afternoon, traders. Coming to you from RJO Futures here in Chicago on Wednesday, April 24th, 2013. I'm here with Jeff Friedman, myself, Bob Haberkorn, and John Caruso, here to discuss the durable good numbers that came out this morning, as well as the GDP number that's going to be out on Friday. Should have some moves here in the market based off the GDP number, expecting 3% on the plus side here. Last quarter it was out at 0.4, so we'll see what comes out of it. I mean, to go from 0.4 to 3, it kind of seems like a big shot considering what the durable goods number did today.
It's a leap, yeah.
But we'll see how it turns out. Jeff, what are you looking at for on the stock side of it?
Well, first of all, we'll rewind to today. Durable goods, very disappointing. You would have thought that the stock index futures would have collapsed a little bit. I mean, we were already kind of collapsing from last week, having the worst week of the year. We were up over 12 or 13% for the year, so a pullback wasn't surprising. This should have been the push to get it over. So what I'm looking at is good news is probably kind of good, but bad news is still plenty good. And give you an idea, I mean, we had like a negative 5.7, and without transportation, we had negative 1.4, and last month we had a negative 0.7. So economic news in general hasn't been all that good. Earnings is kind of carrying the stock index futures and QE3. So that's what I mean by bad news is good. If we get some bad news, then people are going to say that Ben Bernanke is going to continue with his policy for the FOMC. And my thoughts on GDP is, they're looking for 3%. I don't think they're going to get it. We had less than 0.5% last month as an estimate. I can't get it. And even if we get 3%, then it could be revised later. So this is just an advance. This is not the final number for GDP.
What you touched on with the stocks, with the 5.7 durable good number negative, worst reading since August, comes out this morning, and stocks are hovering about even, almost positive. I mean, it's evident what you're seeing right now, and it's QE and the effects of the Fed policy.
I like what you mentioned. The earnings are definitely carrying the markets higher as well. I think what's going on, I think you kind of got the squeeze from hell going on from that low that we put in down around 1530 in the S&P. Now we're trading, a stone's throw away from the all-time high up at 1593. What do you think? Do you think we're going to get a sell in May, go away type effect again this year?
Yes.
Is that going to happen?
That's exactly my phrase.
Yeah.
I think it started in the middle of April. They're going to, and look, it doesn't have to be when they say sell in May and go away. It doesn't have to be, 8% drop.
Right.
We could just kind of start cooling off.
Right.
In 3 months to get 12, 13%, that's like a 4 to 5% increased clip every month, basically. Right. All I'm saying is, they pull back 3 or 4%. We get into a trading range, kind of a sloppy trade. Could do very well if you recognize that's where it's going to be. If my forecast comes true, no one knows for sure. But what I'm saying is, I don't think we're going to be making higher highs. We might not pull back 8%, but I think the thrust is going to back off all summer long.
Right. And I think it's definitely a leap, expecting 3.1% on GDP on Friday.
Yeah.
I think we'll come in down around maybe 2.1, 2.2%. I think that'll be a miss. That could kick off a wave of selling going into May. I think the market's got to it's got to find some fair value for some of these for some of the stocks out there. I think fair value for the S&P right around here. I think we will dip back below 1,500. I think 1,480 is a good target. If we get back down there, that I believe is about a 7 to 8% correction from the highs. So I think we could see that happening.
Yeah, I mean, I think the analysts expecting 3% on the GDP number, I think is way over, setting the bar way too high here, setting themselves up for disappointment. But maybe, we'll see what comes out of it. I mean, to be at 0.4 last quarter, the durable good numbers being where it was, and we have seen some earnings missing. Some earnings have been good, but you Bank of America and a few others that didn't turn out too well. Stocks, 1480, I think you're right around there. It's so hard right now. I mean, the bears in this market, there are bears out there, believe it or not, right now, that are trying to pick tops in this thing. But it's so hard to do right now when you had the monetary policy, the Fed's, has position right now. And to touch on gold and silver, gold, depending on this GDP number, I still think this number won't affect gold so much that it would have in past numbers, just because of what happened last week with the 160.11% drop in the price of gold. You probably see, if it misses being a big miss, you'd probably see gold up another $20, maybe trying to test through 14.55. If it comes out in line, we'll see how it trades out. I think maybe gold goes back down to about that 14 level. But, I've been telling people, keep an eye on the 1430-ish level. That's a big spot. If we get a close above 1430 in gold, it should rekindle, get some more bulls in it, because it seems like people are kind of slowly coming back to the gold market, but not what we're used to seeing on these big dips. But
I've been watching that level too, that 1430 level. For like today, for instance, the high in the overnight I think was 1433. It's having trouble holding that area. So that's
big technical level.
Yeah, it's a tough resistance area for gold.
But, keep in mind, I can tell you there's a lot of people are gun shy right now with what they did in the futures market last week, but we'll see what happens. GDP, though, and that durable goods number, the durable goods number is missing as bad as it did. I think did lend some good support into the gold market here this morning. So, keep an eye on it. If you have any questions, let us know. Do you guys have anything else to add at all?
Yeah, I kind of want to jump in on Treasury bonds real quick. Right now we have seen some flight to safety back into the 30-year and 10-year notes. Right now the yield on the 10-year notes is back around its lowest level since I believe the beginning of January. Even when we see strength in the stock market over the past couple of sessions, you see the bonds kind of hovering around unchanged. They're not selling off. I still believe we got some more upside in us in the 30-year and the 10-year. I think that'll be your major flight to safety trade. If we do get a sell in May, go away effect in stocks, I would set a target for the 30-year up over the 150 level once again. Also, another flight to safety trade that I'm looking at is the U.S. dollar. The dollar has this morning we put in another 2.5 week high in the U.S. dollar. Having trouble holding that rally this morning as it's dipping back into the red, but we are making over the last 6 sessions we've seen a series of higher highs and higher lows in the U.S. dollar. We're seeing the euro drop back below the 130 level. I think that's got some legs, maybe to 84.25 in the near term in the U.S. dollar. That's of course banking on the fact that we do see the bulls take a little bit of a rest in the stock market over the next couple of weeks. So.
Yeah, and at the stock market too. Talk about this. We were talking about it earlier. Jeff and I, and right now with the stocks running as high as they are, to get back to the price of gold and the silver market, I think a lot of eyes are off different markets right now, and they are focused on the stocks with the gains that they've seen over the last year and a half. So, if we do in fact have a sell in May go away, you could have some more focus put back onto the commodity markets that we've seen over the last few years. So something to keep in mind about that. And I think we'll see how it comes out Friday. GDP, durable goods already out today, but if you have any questions, let us know. Feel free to call our desk. Remember to follow us on social media, Facebook and Twitter. Remember, futures trading does pose significant risk, is not suitable for all investors.